For today's episode of Uncapped Notes, we're having a follow-on conversation. This is a good time. If you haven't watched episode 14, What to Expect When You're Expecting Money from a VC, go back and watch that episode. Because today, we're talking about what happens after a VC commits, and sometimes there might be hiccups or delays. And this all has to do with a VC process called capital calls. So, Eric, last September, Hustle Fund announced the raising of Fund 3, $46 million. So must feel pretty good to have $46 million in the bank where we can invest out of now, right?
It would feel really great to have $46 million sitting in a checking account, except we do not have $46 million sitting in our checking account right now, even though we raised that money.
Okay, then Eric, there's an explanation here, surely. Can you tell us more about what capital calls are?
Yeah, and as you mentioned in your nice opener, there's a lot of reasons, frankly, why money could be delayed for reaching founders after a VC commits, but I would say that capital calls is a very prime suspect for why a lot of delays happens. And this is kind of the concept behind it. When we raised that $46 million, Janelle, as I mentioned, it didn't immediately hit our checking account. Our investors didn't wire cash to us. Instead, what the norm is in venture capital is to ask for little portions of that money along the way, typically over the course of years. When we have a deal that's ready to fund, we'll ask our investors to give us that money, which in turn we give to the founders.
Okay, can you explain a little bit more of what that process looks like from the founder's perspective?
Absolutely. So from a founder's perspective, this is what happens. Let's say that we have a talented founder named Janelle. And we say to her, Janelle, you're amazing. We would like to invest $250,000 into your company. And Janelle's thrilled. She signs the documents. We have a great closing process. And you give us the wire information. And you're waiting and you're waiting and you're like, what the heck's happening? So the VCs on the back end, as you're waiting to get your money, are usually writing like an investment memo, trying to document why we're investing, but also informing our own LPs, limited partners. Those are our investors in the VC fund, that we have a deal that's ready to fund and we need to bring down some money. So we will work with a fund administrator on our side, who's usually the person who's helping us to manage cash flow in and out of the fund, and say, put out a call to say that we need to call down 1% or 2% of the total amount that we've raised from all of our investors so that we can have the cash in hand in our checking account to then wire to Janelle. So do you have a sense of why we do it this way versus just ask for all the money up front, Janelle?
No. Can you explain?
I'd be happy to explain. Uncapped Notes is a series produced by Hustle Fund designed for first-time founders.
Follow us on socials and don't forget to comment, like, and subscribe.
And this is not obvious. When I was a founder, I did not know this stuff. The reason why this works is it's really driven by this concept called IRR, or internal rate of return. So let me give you this example. Let's say that we ask for 100% of the capital up front. We ask for all $46 million, and it's day one of our fund. And we're about to issue a $250,000 check to Janelle. Well, that basically means that $45.75 million is still unused, right? And that's money that's not being put to work. It's in a checking account. It's maybe not even earning any interest. And what that means is that money is not being optimally invested in anything because we're prematurely putting it into our checking account. This could have been money that the LP could have been putting in an index fund or a real estate or something else that's generating cash as they're waiting for us to fund deals. So what that does is when you have a lot of cash that's not being put to work because you're just in the early days of your fund, that's actually suppressing the performance of the fund as well, because this is just cash that's not earning. Now, IRR is calculated on the money that you call down. That is the money that you've received as a venture capital fund, and the valuation of the businesses and their performance thereof once you invest in moving forward. So you get the benefit of seeing positive IRR or positive performance in your fund in the money that you invest in only. I know that this is a bit of a nuance. It might be even a little bit more information that founders need to know, but it's good context for founders to have because they need to realize that they should expect at least some level of delay for most VC funds due to this optimization of IRR, which is also the root of why we do capital calls in the first place as a fund.
Got it. So you're going to invest 250K in my company. Thank you, by the way.
Mhm.
And how quickly can I expect to see the money? What's the typical wait time? And are there other things that can go wrong?
Yeah. So great questions. And I'm sure a lot of founders are also thinking this alongside of founder Janelle. So what's the delay? I would say that a typical call, if I were to look at most limited partner agreements that I've seen, is a 2-week window, which is I put out a notice saying, I need some money, Janelle, or in this case, maybe Janella, the rich aunt who is the investor in our fund. Janella, we need money, right? Normally there's a 2-week grace period window for that LP to then send in the money. So expect that there could be delays there. At Hustle Fund, we actually do a very different kind of capital call structure. We do actually call a little bit more money than we normally need at any given time on a recurring basis, so we can actually wire faster. And that's slowly starting to become a bit more common, but it's still pretty uncommon. Now, other things that can create some delays here. So a lot of times a founder who understands the capital call process might ask like, hey, is there a chance that some people will not wire the cash? Will they be really delayed? Maybe they're on a vacation in Europe or something like that. Some delays are somewhat common to see in our industry, but it is super rare for an LP to completely miss or ignore a capital call because there's some very punishing consequences that we won't get into too much detail, but it's basically really, really bad for the LP to do that. And it's also reputationally super damaging too, Janelle.
So, Eric, what happens if you discover my wonderful company and it's towards the end of the period of time where you're going to be investing out of that fund three, the $46 million? So you've already invested, let's say, $43.8 million, and you're going to put a small check into my company, then evaluate me and decide if you want to do the full 250, which is that unique hustle fund investing model. What happens then?
Yeah, so this is pretty interesting. I kind of very briefly mentioned this at the top of our conversation, which is when you do a capital call, it's normally called by percentages. You say, I want to call down 1%, I want to call down 10%, whatever is the equivalent amount of cash that you need to serve that investment. Now, a fund only goes up to 100%. So at 100%, that means we've called down all $46 million. And this is actually where founders often miss the critical question that Janelle is citing, which is what percentage of your fund has been called? This is a very important question for founders to ask their investors. And I've never remembered a single founder who's asked that to us. But the idea behind this is it is considered very bad practice to be investing an initial check into a team if you're, say, 90, 95% called. And it's a bad user experience for the founders too. Let's say that Janelle is a promising founder. We are pretty much at 100% called, but we are able to sneak in one final initial check into her business. And then Janelle says, oh, great, things are going well. And I really want to work with you to lead our Series A or some sort of much larger round. And the response I have to say to you is like, we have no more cash. We're nearly 100% called here. So sorry. The reason why founders should ask this question, like what percentage capital called you are, you want to understand how much cash is available, just so you at least have the option of working with that VC to provide more capital into your business at later stages. And I would say that it is a light red flag. You still may want to take that check, but it's something at least to be aware of if a fund is pretty much at the end of its life. One postscript, by the way, Janelle, which is, in our industry as venture capitalists, it's considered best practice to write all of the investments out of a single fund for a given company. So usually you don't see as much cross-fund investment, meaning like maybe we have a fund 3 where we write a check into Janelle's business, but then we use fund 4 or fund 5 money to invest in subsequent fundraisers. It does happen sometimes, but I think that a lot of the time the norm is still to keep it within a single fund. So this notion that you've run out of money out of your fund is real. Even if you raised a fund 4 or fund 5, you may not have access to that cash depending on how these limited partner agreements have been arranged. So again, that could be another question that a founder could ask to their investor when it comes to what happens with subsequent investments. Is that available to me? And how called are you?
Okay, Eric, that was a lot of really helpful information on capital calls. Founders, if you want to read a little bit more, Elizabeth Yin, one of our general partners, did a tweet storm on this, and we'll be sure to include the link to that tweet so you can reference that for more information. And this would be a good time to go back and look at episode 8, how to conduct investor reference calls, because Eric just gave you 2 more good questions to ask investors when you're thinking about having them invest in your company.
All right, founders. So now you should be an expert on capital calls. Please add any comments that you have if you have questions about this episode. And don't forget to like and subscribe to Uncapped Notes.